everybody, and welcome to this July 12th Economic Impact short video. As usual, I am with our chief economist, Stéfane Marion. Hello, Stéfane.
Hello, Martin.
So let's start with some worries on the currencies and interest rate market, Stéfane. What's going on?
Yes, big development, Martin, in recent weeks. We've seen treasury yields actually going lower, despite rising inflation, and at the same time that is supporting U.S. dollar appreciation. So the question now is this a new bull market? And when you have treasury yields going lower and U.S. dollar getting stronger, that's normally not a good omen for financial markets. From my perspective, I think that the biggest factor that can explain the recent behavior of these asset classes is what's happening on the pandemic front. And we can't ignore it, Martin. It's not finished.
We get back to this, want it or not.
New variants, rising new cases, that's the blue line on the chart. But the good news is so far the death rate is fatalities are very low. So, but people are concerned that there might be contagion to the rest of the world and that could slow economic activity in the coming months. I think, Martin, to envisage new sectoral shutdowns or economies that would start closing again, we have to look at the pressure on the healthcare system. And what you can see on this slide is the gray line, the ratio, despite new COVID cases, hospitalization rates are the lowest we've seen in the UK. Since the start of the pandemic. And UK is probably our best base case to analyze what's happening with the variants. And maybe that's a proof, Martin, that the high vaccination rate is keeping pressure on the healthcare system relatively low. And if that's the case, then we will be able to reopen the economy. Think about the UK. They're supposed to announce the grand reopening on July 19th. So far, so good on that front, Martin.
So let's go back to fundamentals. How are global economies doing?
Well, best economic momentum since 2006 globally. So that's good news, Martin. And normally when you have good economic momentum like this, that also translates into good performance of equity markets. So globally, equity markets are up new record high early in July. So notwithstanding certain asset classes are quite nervous, the reality is the stock market is still betting on a global economic recovery in the months ahead.
And we've been talking about all those records every couple of weeks, but the stress remains very low for financial markets.
Yeah, so you can't aspire to a strong economic rebound or long-lasting performance on the stock market if financial stress is getting higher. So the good news on this slide is, listen, we've had central banks that are extremely accommodative. The ECB, European Central Bank, has a new mandate where they're much more tolerant on inflation. China actually reduced its reserve requirement ratios, so that keeps financial stress low. So I think that's a good omen for global growth. And it means for the stock market that you have a stock market that will rise with a backdrop that is favorable for higher profitability. And notice on the slide that profits as we speak are already back to pre-COVID level in a span of just 18 months or so, whereas it took almost a decade to get back to pre-COVID level, pre-recession level after the 2008 recession. So the profit recovery is quite interesting at this point in time.
And if we want to know if this will continue, the inventory to sales ratio is a good indicator, and it's pretty staggering.
I think that's important, Martin. It's an important point because expectations are for profits to rise 20% in the coming year, and I don't think it would be achievable were it not for the need to rebuild inventories. So if you look at in the U.S. at the retailer level, retail sales, inventory to sales ratio are the most depleted on record. So to me, it would suggest the need to rebuild inventories, which will be quite aggressive in the coming months and will help support the global economy. Demand for commodities, etc., should be relatively strong.
So Dr. Copper's down a little bit, but you're not worried?
I'm not overly concerned, Martin. Yes, the doctor is down a bit now, but I don't think it's down for the count because the reality is we're still at very, very high levels. And Martin, look, the cost of shipping a container globally is a new all-time high. So I think the inventory rebuilding cycle is still in motion. So the reflation trade is not dead.
And Canada must be doing well in that environment.
Oh, small open economy with global trade flows that are surging, we should be doing well. And the good news is that business sentiment is at a record high. This is a Bank of Canada measure, Martin. So new record high. And normally, if you have business sentiment that is relatively high, then you have a good performance on the job market. So although we are not back to pre-COVID levels on total employment in Canada, Martin, notice on this chart that we're less than 2% away, whereas in the US, it's more than 4% away. So that would suggest that since employment is an important component of the reaction function of central banks, I think that the Bank of Canada will be a little bit more aggressive than the Federal Reserve in the months ahead in reducing liquidity in the system.
And something we have not looked at in a while is where are those jobs created, and the impact on the Canadian economy is really important.
That is so important, Martin, because never forget that when it comes to Canada, 40% of GDP is determined by the top three metropolitan areas, so Toronto, Montreal, and Vancouver. And you'll notice on this chart that for Montreal and Vancouver, it's a new all-time high on jobs. In June, Toronto is catching up. But notice the divergence with the US, where the top three metropolitan areas account for roughly 20% of GDP. Employment in those three metropolitan areas is no higher than it was a decade ago. And of course, this outperformance on the Canadian front means that you're also outperforming in terms of home prices. And you can explain the divergence between the two countries based on these fundamentals. So that suggests limited negative wealth effect or limited downside for home prices in the coming weeks.
Stéfane, you mentioned liquidity in the Bank of Canada. Maybe just a quick word on the Canadian dollar.
Yes, Canadian dollar has been not performing so well in the past few weeks, Martin, losing 5 cents despite higher oil prices, higher interest rates in Canada, good economic momentum. So I think that in July, the Bank of Canada, this week actually, the Bank of Canada will be announcing another reduction in its quantitative easing. And I think that could be supportive to the Canadian dollar. Because, Martin, throughout the pandemic, people have been wondering what will happen to downtown areas. And given the jobs numbers that we're seeing for Montreal, Toronto, and Vancouver, I think that the Bank of Canada can afford to reduce quantitative easing, and that could support the Canadian dollar. So we lost 5 cents. We expect to get it back in the coming weeks if we are right about our scenario for global economic activity.
So in conclusion, we remain positive about economic growth for the second half of the year. The outlook for 2022 remains fairly positive also. But Stéfane, we need to watch the variance as well as the end of government subsidies.
That's a good point, Martin. That will come later this fall. How will consumers react when support programs are not in place? We need to get better job creation in the weeks ahead, and we'll need to watch that. So the variance and job creation remain key to the outlook.
Excellent. So thank you, as usual, for watching. Thank you, Stéfane, for being with us. We will take a couple of weeks off, and we'll see each other in August. Thanks for listening. Take care.